Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. Now, I'd like to discuss an interesting question today. In a mutual fund portfolio, is it more beneficial to have a concentrated list of stocks in an equity portfolio, or should you have a large number of stocks that are diversified? It's an interesting proposition because if you compare flexi-cap funds and focused funds, the thesis essentially is the same. The fund manager has pretty much a blank slate to choose where to invest. Except in focused funds, the requirement is to have 30 stocks that they have to choose from, and that's the maximum that they can keep. So it's a pretty concentrated portfolio. Let's talk about what has worked over the course of the last several years and how a focused strategy might fit into your portfolio. Prableen Bajpai, the founder of FinFix Research and Analytics, is joining me today. Prableen, thanks so much for taking the time. I thought this would be an interesting conversation. So first, let's define what focused funds are. What are they, and what is their purpose?
Hi, Alex. Always great to be on your show. Just like you said, that flexi caps is one of the category wherein we have the freedom to move about anywhere in the market cap space. So it can be a large cap, mid cap, small cap stock that one can pick. So focus funds are a concentrated format of a flexi cap because we have a capping of maximum 30 stocks. So the fund manager has the freedom within this universe of all the stocks which are available anywhere the fund manager, he or she can invest, restricting the maximum number of stocks to 30. And that is the differentiating factor between flexi caps and focused. So focused funds have to keep 65% in equity at all times, like a typical equity fund, Alex, to get the taxation. And other than that, this 30 is the restrictive criteria which they have. Now, because we're talking about, flexi cap kind of becomes a natural benchmark for comparison when we're talking about focused funds. So just to give a perspective that how concentrated these funds can be in terms of the stock holdings. So if you're looking at currently the category focused funds has roughly 28 schemes, which are total AUM of about 1.62 lakh crores, which is 1/3 of flexi caps in terms of AUM. And if we look at those focused funds which have a track record of 7 years, and then we look at the counterparts of the same schemes within the flexi-cap space, and we do a comparison, then the lowest holding in the top 10 stocks for a focused fund stands at 56%. In case of a flexi-cap, it is at 28.53. So basically, the lowest is double of a flexi cap. So it's a higher concentration portfolio, which tells us. And the highest in the top 10 for a focused fund is at 74.39%. That means the top 10 stocks alone have a 74% allocation, which in comparison of a flexi cap is at 46. Now, of course, we are talking about 16 schemes here, which have a track record of 7 years plus. So it's comparatively limited as compared to the overall universe of 28 schemes which are there. And one more point here, Alex, that out of these 16 schemes for focus funds, we've had roughly 11 schemes which have a higher allocation of more than 50% in the top 10. So there's a very small percentage, which is like these 5 schemes which are left behind, which have a overall focus concentrated portfolio, 45 to 50 stocks in the top 10. So overall, just to the point that, it's a higher concentration bet that we are doing. And of course, I think a lot depends on the fund manager here than, what general markets are going to perform.
So then the next logical question, Prableen, is has one strategy performed better than the other? One would assume that if you have a concentrated portfolio, you will tend to have more volatility, potentially, because you can swing quite sharply either way if you have a higher weightage of stocks.
Absolutely. So because the comparison stands with FlexiCap and in focused, the very idea that why somebody should invest is that, these are sort of high conviction bets, and it can work both ways, Alex, because we are taking a concentrated portfolio. So if you're looking at the volatility currently, and we see how these funds have performed during, let's say, market downturns and in terms of standard deviation, if you're just looking at standard deviation, then amongst and we just put these flexi caps and focus funds together, and then we filter it in terms of the highest standard deviation. Then amongst the highest 10 funds, which have the highest standard deviation, seven of them are focused and three of them are flexi caps. So definitely in terms of volatility, which standard deviation is a standard measure of, it tells us that the volatility in these funds will be higher. In terms of market falls, if we look at the top three falls during the last 7 years, then we see that in comparison to a flexi cap and even in terms of category as a whole, the flexi caps and the focused funds, the highest falls are seen by the focused funds. So these are the falls from, one is the COVID fall, the second is the fall from October 2021 till June 22, and the third is since September last year till April of 2025. So during all these times, the highest fall within these two categories was seen by the focused funds. So definitely on the downside, we are taking a higher risk.
Okay, interesting. And just a small point to those tuning in, if you're not familiar with how standard deviation works in the context of a mutual fund scheme and its performance, simply put, in a certain time frame, if the compounded return is, say, 10%, and the standard deviation is 10%, that means that at any given point of time, you might have been earning 10% above or below that average. So you could have been receiving zero returns. Praveen, is that a fair assessment of how standard deviation works? I'm just checking. You're the expert.
Right, Alex.
Okay, all right. So let's talk about pros and cons. And you've already kind of addressed a few of these, but there are definitely some pros associated with focused funds as well, Prableen.
So pros, ideally, Alex, why should one invest in a focus fund is because we feel that, a high conviction bet can earn us better returns. Now, we earn better returns, that will happen when we're discussing returns now. But are we able to do that? Ideally, theoretically, yes, we should be able to do that. But is it always happening? Actually, no. But one of the pros can be definitely that there is a potential to higher returns. The second one is that it can be, suited, or for the pros can be that it is for investors who are looking to have concentrated bets. And if those work, then of course there is a much higher potential for upside, and you have a significant allocation to a particular stock rather than having these 50-70 stocks in a portfolio with just about 2 and 3%. Here the concentration to a particular stock is definitely higher. So that can work in the favor of a focused fund. So these are the minor pros. Cons, of course, if we look at the returns also, and we know that the concentration in the portfolio can work either ways. So that can be a negative as well, because it's a concentrated portfolio. And let's say even if two stocks from those which are held don't perform, it can actually pull down the performance quite a lot. So it eventually boils down to the fund manager's skills. So I would say that the fund selection risk is even higher. So what we are seeing typically that in any of the active funds, we are seeing that the fund selection risk is very high, Alex, with the kind of differences that we see amongst the best and the worst performers. So I think that actually gets accentuated in a focused category. And, that we'll see when we're just talking about the returns.
No, absolutely. And this is a logical thought, right, Prableen? Because ultimately when you have, for example, if I select 10 stocks and my neighbor selects 10 stocks, the probability of one of us sharply outshining the others exists. And when you have schemes to choose from that are each making these choices of a select number of stocks, then the possibility of outperformance or underperformance, relatively speaking, is quite considerable, particularly because there's likely to be very little overlap between these portfolios. So having said that, there are a few schemes that have achieved a certain track record and that have a certain assets under management base, right? 10,000 crore, pretty large if you think about these focused or concentrated portfolios. Does that make it easier or harder for the fund manager to operate, in your opinion?
This data is very, very interesting, Alex, because there are currently, out of these 28, there are currently 5 schemes which have an AUM of more than 10,000 crores. And then there are a couple which have like 8,000 crore AUM. So overall, it's a very small AUM as compared to the size of how, flexi cap funds have grown. And the smallest AUM is just about 180 crores here. And the maximum is at 41,000 crores. So it's a huge range. And typically what one assumes that, as the AUM increases, maybe taking exposure to high conviction bets can become difficult. But data is suggesting, and on 3 parameters we look at the data. One is in terms of the rolling returns, second SIP returns, and the CAGR. So point to point. So if you're looking at returns on 7-year criteria, so in terms of rolling returns, so we look at a 2-year rolling window over a 7-year period, and we see that 3 out of the top 5 performers actually have an AUM of more than 10,000 crores. So 3 out of 5, not bad. And actually the scheme as the 6th place also has a very huge AUM. In terms of SIP returns here, 3 schemes again are in the top 5. So if we are looking at XIRR returns, then again AUM has not been a deterrent, and 3 of the top performers are amongst with AUM higher than 10,000. And if you're looking at the compounded returns, the CAGR, then again we have 3 schemes which are in the top 5. So at this point, it would be wrong to say that a higher AUM and with this benchmark of, let's say, 10,000, what we've said, that the performance is getting impacted. In fact, only 1 scheme out of these 5 schemes, which has an AUM of more than 10,000 crores, has lagged on all 3 return parameters. Otherwise, they're there. And I think that has not been a deterrent. Also because 10,000 crore in itself, I think, is not a very, very huge AUM.
That's fair. It's not, but it's interesting nonetheless to say that in a concentrated portfolio, 10,000 crore rupees, which is the highest more or less in that category, is not a reason for underperformance. But the last point, Prableen, which is the most important point, because we have to give our viewers actionable insight, which is, should they be investing in this, and who should be investing in it? What is the role in a portfolio?
So before we do that, Alex, I'll just give a little overview of how the returns have been. So because I think flexi caps and focused, these are the 2 funds which would compete against one another. So I don't think that anybody should look at a focused fund in addition to a flexi cap. It can be for an investor who's looking for a more aggressive format of a flexi cap fund. So if you are having a portfolio with, let's say, some passives in your portfolio, some other schemes, you have the mid cap and the large cap, and you're wanting to add a flexi cap, then that is where you check that maybe a focused fund can be better if you are a high risk investor. And of course, only if you have a horizon of, let's say, 7 to 10 years and above, because it's a concentrated bet, so risk is slightly higher. Having said that, besides the suitability, also in terms of returns, Alex, on a 7-year basis, if you're just looking at the SIP returns, then the highest between the focused and the flexi have actually come from a flexi, which is at 23% as compared to 22% for a focused fund. If you're looking at rolling returns 2-year over 7-year period, then again, for a flexi cap, it is at 23.89 as compared to about 18.32 for a focused fund. And even in terms of point to point, a 7-year CAGR, it is 23 for a flexi cap and 20% for a focused. So I think there'll be certain segments, there'll be some cycles in the market when focused can actually outperform, but then it definitely involves a high fund selection risk, and it is for somebody who can have the patience and has a higher risk appetite, but it can be seen and viewed as a aggressive, concentrated flexi cap. And I think that is the approach with which investors should sort of look at focused funds.
So it doesn't necessarily have to fit into your satellite portfolio is what you're saying, right? Prableen, broadly, it shouldn't be a satellite approach. It can form part of your core.
It can, Alex, but I think it has to be with a mix of index funds. Sure. Then it should be probably the active and passive approach kind of a portfolio overall. Absolutely.
All right, Prableen, thanks so much for taking the time. Absolute pleasure having you as always.
Thank you, Alex.